I'm going to show you how we helped a client qualify for health insurance subsidies that saved them about $15,000 per year in retirement. Then I'm going to show you what this client almost did to lose the entirety of that subsidy. So follow along closely as I show you what you need to do to qualify for a health insurance subsidy, as well as a common error I see people make that ends up costing them thousands. I was recently working with a client who retired before Medicare age. So if you retire before Medicare age, you have to find a health insurance option. We looked at COBRA for them, we looked at the marketplace, we looked at a few different options, and ultimately we decided the plan from the marketplace was going to be best for them. Here's an exercise we went through. What you can see here is an online tool that you can actually use to estimate what subsidies you might qualify for. This is kff.org, and what you can do is you can come in here, like we did with our client, although we helped to coordinate this with an actual health insurance team. We selected the state that they lived in, their zip code. We entered their projected income. Now this is important. This is their modified adjusted gross income that we entered in right here. More on that later. Next, we said, is either of them covered by their spouse's employment? The answer was no. They had 2 people in their family and 2 adults that were between the ages of 21 and 64. Of course, at age 65, they would then qualify for Medicare. So we went through this tool, entered their age, number of children, and we hit submit. This is something you can do on your own as well using this tool or others like it. And what we saw was that for the plan that we were looking at for them, they had a projected subsidy of $1,252 per month or $15,000 per year. So what this is you might hear this referred to as a subsidy. You might hear this referred to as a premium tax credit. Technically, the premium tax credit is what it's called, but subsidy is what I'm going to call it here just for short. So when we looked at that, they were thrilled. That saved them quite a bit of money on their health insurance bill, $15,000 every year up until they were eligible for Medicare. Now they saw this and thought, hey, this is great. This is going to save us a lot of money in health insurance premiums. We're really happy about that. We've also been following along. We know there's this thing called capital gain harvesting or long-term capital gain harvesting. So they understood that. And what that is if you look at this important sheet right here, which by the way, a link to this, if you want to download it, is in the resources below or the notes section below. And what you can see here is if your taxable income, you're married, filing, and jointly, is under $94,050 for 2024, you don't pay anything in long-term capital gains taxes or qualified dividends, same thing. If you're single, that number is $47,025. So they said, hey, wait a minute, we're projecting this income of $65,000 and we're getting this great subsidy. Well, at the same time, if our income is so low, let's simultaneously take advantage of this tax gain harvesting. Let's sell some of our appreciated assets, realize or lock in that gain, don't pay anything in terms of federal long-term capital gains taxes, and it's a win-win. Get the subsidy, realize some gains, and don't pay any taxes on that. Very common thinking until we started to show the difference between how health insurance subsidies are calculated and what income that looks at versus the long-term capital gain taxes and what income that looks at. Let me show you what I mean. We put together this very basic spreadsheet for them. And I want to be very clear. This is not encompassing all the different variables that are going to be factored into taxable income or modified adjusted gross income. So keep that in mind. This is by no means comprehensive. Talk to your tax advisor, talk to your financial advisor to make sure the projections you're running are accurate. But this held some of the core stuff to help me illustrate the point that I was trying to show them. For this particular client, we walked through their different taxable income sources. And so that's what you're looking at here. Right here, you can see the differences for 2024 ordinary income tax brackets for married filing jointly, as well as long-term capital gains tax brackets for married filing jointly. For these particular clients, we said, okay, you're gonna have $20,000 of income this year from salary. Now, technically they retired at the end of last year, but they had some PTO that wasn't paid out until the beginning of this year. So that was booked for 2024, that was $20,000. We looked at their cash accounts, any bonds that they had in their brokerage accounts, any interest-bearing assets they had, and estimated that they'd have about $8,000 in interest this year. That is subject to ordinary income taxes, so we're including that. $3,000 in non-qualified dividends, and they had about $20,000 that they were planning to take from their IRA this year based upon part of the withdrawal strategy that we had worked through with them. Now, as we look at all this is before doing any Roth conversions, this is before doing any tax gain harvesting, this is just the income sources they were gonna already have before implementing any tax strategy. Now, these clients were smart. They said, hey, wait a minute, our taxable income, which is their modified adjusted gross income, which is just a sum of these. And again, I want to be very clear, there are more details and more factors than just this that actually goes into your modified adjusted gross income calculation. I was just illustrating the core income sources they had that contributed to theirs. For this year, the married filing jointly standard deduction is $29,200. So if here's their adjusted gross income, modified adjusted gross income, here's their deduction, here was their taxable income that was subject to ordinary income rates. So you could see this and we compare this to say, wow, we're actually in a pretty low tax bracket. This ordinary income puts us in the 10% tax bracket. This ordinary income, or this taxable income, I should say, also puts us in the 0% long-term capital gains and qualified dividends tax bracket. So they said, James, why don't we also take advantage of that? Let's get the subsidy while simultaneously taking advantage of tax gain harvesting. Well, that's when I showed them this. I walked through this and said, look, your difference between your taxable income today in the top of the 0% federal long-term gains tax bracket, there may be a state gains tax bracket depending on the state that you live in, or capital gains tax depending on the state that you live in, but they had $72,250 to go before their taxable income exceeded the top of the 0% bracket. Or in other words, they could realize up to $72,250 in long-term capital gains and pay $0 in federal cap gains taxes on that. So they're delighted by that. They say, hey, we got a lot of gains in our brokerage account. And they said, James, what if we didn't use the entirety of this, but even just to be a little bit on the side of conservative, what if we realized $65,000 in long-term capital gains? Well, here's what that would mean. Their taxable income that was subject to ordinary income rates. Ordinary income rates is the things that you pay taxes on, things like your salary or interest or non-qualified dividends. That actually wouldn't change. They would still be in the 10% ordinary income tax bracket because of the types of income they had subject to ordinary income taxes. Their taxable income, which is including both their long-term capital gains plus any ordinary income here, they're still in the 0% tax bracket for that. So it seems like a win-win. We're still in a low ordinary income tax bracket and we're paying 0% taxes for those long-term gains. But what they didn't realize is that while they're doing that, your health insurance subsidy is looking at this top line here, your modified adjusted gross income. And their modified adjusted gross income all of a sudden jumped up to $116,000. Just for perspective, what that was before, that was $51,000. If they realize $65,000 in long-term capital gains, even though they're not paying federal capital gains taxes on that, because these are long-term gains realized under that threshold, the 0% threshold, that is still included in your modified adjusted gross income. This is a very common mistake I see a lot of people make. I wanted to show them then the impact. So hey, before we go do this and then realize the unintended consequences later, let's actually look at this. And in fact, let's say what if you did fully realize all the way up to the 0% tax bracket, or the top of the 0% tax bracket. In that case, our modified adjusted gross income would be $123,250. Well, if we go back here to this calculator to get an estimate of what that might look like, $123,250, as we start to look at that, keep in mind that our subsidy before was $15,000 per year. If we refresh this, now it's dropped by about $6,000 per year, a little over $6,000 per year. So here's the thing, it still could make sense to do this. And this is where tax planning comes into play. What you have to effectively do though, is you have to look at those long-term capital gains that they realized, the $72,000 and change, and say it wasn't really a 0% federal income tax that you paid on that. Sure, you didn't have capital gains taxes on that, but it caused you to lose a little over $6,000 in subsidies. So that lost subsidy is in a way needs to be factored in like a tax. Divide that by the gains realized to then come to that break-even analysis to understand, is it worth it to realize these gains, or is it more advantageous for us to take the subsidy and keep those gains down, at least for this year? So here are the takeaways I want to leave you with as we're walking through this together. The first thing is that things like Roth conversions, things like capital gain harvesting, long-term gain harvesting, those are based upon your taxable income. Your taxable income is your adjusted gross income minus any deductions, standard deductions, itemized deductions, anything like that. What does that mean? Well, effectively what it means is things like more charitable giving, more mortgage interest paid, other deductions like that are decreasing your taxable income. So if you're going to implement Roth conversions, if you're going to implement tax gain harvesting, there are things you can do on the deduction side. Do we gift more to charity that year? Do we have other deductions like that, more medical expenses, whatever the case might be? You can strategize on that end to offset or lower your taxable income. On things like health insurance subsidies, what they are looking at to determine your subsidy amount is your modified adjusted gross income. Your modified adjusted gross income is the same as your adjusted gross income, but you add things back in. Like any portion of Social Security that wasn't included in your taxable income is included in your modified adjusted gross income. Any tax-free interest, so things like municipal bonds, any of that that's not subject to taxable income is added back in to your modified adjusted gross income. So it can be very confusing because sometimes people just say, oh, what's your income? That's going to determine your Roth conversion amount or your tax gain harvesting amount or your subsidy amount. But when they say income, it's not always being referred to as the same thing. You need to understand, is that modified adjusted gross income? Is it taxable income? What are the implications of that? And then how do you start to prioritize the various tax planning opportunities in front of you based on those two different income types? Now, along those lines, one of the most misunderstood parts of tax planning is how does realizing long-term capital gains impact my ordinary income tax brackets? Well, I made a video right here. And what I do in there is I talk through, can realizing long-term capital gains actually impact the ordinary income rates that I'm paying or the other income sources that I have? So take a look at that and I'll walk you through the relationship between ordinary income and long-term capital gains and what that means for you. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.